Is there a specific factor that you're currently looking at as you're building out new strategies, or are you placing importance to every factor equally?
So no, for us, because we do our own proprietary passive and active strategies, and we have multiple different factor models, we're just blending them together, not necessarily building any other new strategies out at this point, because we run about 30 different strategies. So we cover all sorts of different avenues that are factor oriented, from the simple American Leaders Index that we had mentioned earlier, which is a size-based factor system, very simple in its approach. Simplicity can sometimes go a long way. We don't change our factors around. We don't adjust the factors. I think that's probably one of the biggest differentiating ways we build our models. We don't adjust factors. Once we build the models, the factors stay the same. In the case of like American Leaders, we're the value momentum leaders. That strategy, we have not adjusted any of the factors, for the last 20 years. And we feel it's served us well. Now, do factors go in and out of style? Yes, absolutely, 100%. But we really believe trying to isolate what we believe are the good factors to build long-term models and then don't adjust them. We believe that's a core tenet of how we build the strategies. We don't do factor chasing. I think that's the biggest thing.
Our focus is actually whichever factor is in question, to isolate its best capture. So if you want to build a momentum factor portfolio, then what's the best way to isolate the momentum factor? And when we say best, it means ensuring that the risk premium that's captured is largely because of momentum. Of course, you can never have it 100%, but you neutralize the effect of other factors. Similarly, for dividend yield or volatility, will be the same, that you want those factors to be the ones that are driving the risk premium and not size or anything else. So we're looking to deliver a factor portfolio as a building block, and then as BX does, it can then be used in a blended model to deliver the US momentum effect or the US dividend yield effect. So we're not looking to say this is the time to buy momentum or this is the time to buy vol. That's up to the client, but we are providing the instrument by which to capture momentum most effectively, or dividend yield or low vol.
Yeah, I mean, I would agree with both Arno and Aaron on this, that the important thing is that we construct portfolios to be essentially factor neutral, so that an investor who wants to buy value is buying what we consider to be value at this point in time. And an investor who wants to buy across a multi-asset portfolio of value, deep value, quality and growth is equally exposed to those factors. We're not taking a factor timing approach in portfolio construction, but we are allowing that to be the prerogative of the investor, to the extent that we can add layers of insight into whether we think value or deep value is making more or less of a difference. One thing that we know from the research we've done over the years is dynamics of returns are not normal. They're not normally distributed, and they're not stable. In other words, what you have is you have a much higher degree of spread to non-linear returns amongst growth stocks and deep value stocks than you do them amongst value and quality. So these are sort of the tails of a skewed distribution, if you like. We do get outsized returns in the tails, so we know that there's higher returns and higher volatility in certain factor baskets. So add to Aaron's point about momentum, we have a proprietary measure of momentum, and what we consider to be a measurable and quantifiable view of momentum is not just price momentum, but we actually measure the momentum of the change in expected returns. So if expected returns are relatively stable, then the momentum is zero. In other words, the second derivative is zero. So you've got no acceleration. But when you are seeing a change in expected returns, expected payoff for a stock, you then start to get a change in market expectations, and that leads to the price momentum. And that can happen to any stock. Indeed, it happens to every stock. So we don't treat momentum as an isolated factor. What we look at is that you can have a value stock that's got positive momentum or negative momentum as a function of what the market's changing view of its future outlook is.
Chris McAfee, do you want to quickly just go through why this is all equal weighted? Is it simply because you wanted to protect the diversification aspect of it, or what was the thinking around weightage?
Yeah, I think you kind of hit the nail on the head there. So what we wanted to do here was create a portfolio that gave you exposure to these different factors. And there wasn't, you could run this through some sort of optimization strategy and come up with a portfolio that at the end of the day wasn't all that much different than this. The 20% allocation to each just worked out really well in this particular case. So we kind of left it at that.